Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, welcome to Cut to the Chase. Today is Wednesday, the 26th of August, and my name is Fook Hien. Our house view has been overweight on global equities for over a year now, and this has worked well for us. We went through the recovery after Liberation Day last year when the US unveiled global tariffs, and we stayed overweight equities through the Middle East conflict this year as well, and again that worked well, with global equities making new all-time highs in the months of April, May, June, and recently in August. A key factor driving our conviction to be overweight equities has been strong earnings growth, and this continues to give us confidence. Global equities is expected to see strong earnings growth of 32% this year and 14% in 2027. Our preferred markets regionally are the US and Asia ex-Japan, which have the strongest earnings growth this year and in 2027. However, the market I want to discuss today is Euro area equities, which is interesting because earnings are showing a positive inflection after 3 stagnant years. In 2023, 2024, and 2025, Euro area equities have seen earnings growth of less than 1% each year. In contrast, this year, earnings are inflecting higher and they have been revised upwards following a positive Q2 earnings season. Consensus expectations are for earnings to grow by 17% this year and 10% in 2027 for Euro area equities. The good news is that this earnings growth is broad as well, with positive growth expected for all sectors this year, from a low of around 1% for real estate to a high of over 70% for the energy sector. While the energy sector is being supported by high oil prices, we see this broad strength in the Euro area as being supported by fiscal expansion, which is lifting domestic demand. Whilst the positive inflection is good news for the Euro area, we maintain a core allocation to the region as earnings growth is still higher in the US and Asia ex-Japan, which are our preferred regions. What this means using a multi-asset portfolio, such as our CIO Foundation portfolio for a balanced risk profile, is an allocation of around 7% to Euro area equities. For investors looking at sector opportunities within the Euro area, our preferred sectors are financials and industrials. Euro area financials benefit from a higher for longer rate environment after the European Central Bank's rate hike in June this year, with the market expecting more hikes to come. The financial sector is expected to see earnings growth of 12% this year and next year. With strong balance sheets, this is also supporting an attractive dividend yield and share buybacks in the sector. The second sector we are overweight is Euro area industrials. We expect EU fiscal stimulus to be a tailwind, supported by Germany's new infrastructure acceleration law. We see the increase in European defense spending and the global electrification trend also benefiting Europe's industrial sector. Consensus earnings growth is around 18% this year and 17% for 2027 for the Euro area industrial sector. That's all I have for today. Thanks for listening, and I look forward to speaking with you again soon.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.